Today I'm going to do a video on accounting equation, or sometimes it's known as AOL. Before we get to the actual table, I just want to remind you of your journals and your source documents, because sometimes the table includes those. Okay, so starting with your cash receipts journal, remember that when we receive money, there are three possible source documents here. Bank statement is if someone deposits money directly into the business bank account. They transfer money by EFT, or they go into the bank and just deposit straight into your account. A cash register tape, CRT, is for cash sales. A receipt is where the person comes into the business to pay, and we need to keep a record of his name. So for example, if a debtor comes and pays you back, we need to know who's paying us back, so we're going to give him a receipt. Then your cash payments journal, that's used for payments made by EFT, by debit card, or if you withdraw cash, and the source document here is either bank statement or you can use EFT for the EFT payments. Debtors journals when we sell on credit, okay, and the document there is invoice. Creditors journals where we purchase on credit, we buy on credit, the document is also an invoice. The debtors allowances journal is if the debtor returns stock or we give them an allowance. The document we use here to record that is a credit note. And then creditors allowance journal is if we return to suppliers or the creditor gives us an allowance, and here you can either use debit note or credit note. You're also going to need to know your terminology, your basic account types. So first of all, assets, those are the belongings of the business which have lasting value. So for example, a vehicle. Expenses are your daily running costs of the business. So you have an asset, a vehicle, but if you don't pay for petrol, which would be the expense, the vehicle can't go anywhere. So in the same way, you can have all the assets you like, but if you don't pay salaries, stationery, water, electricity, telephone, etc., your business cannot function. So your expenses are those daily running costs. Income are amounts earned by the business, for example, sales or rent income. Liabilities are debts of the business, what you owe to outsiders, like a loan or creditor's control, and owner's equity is the worth of the business. Now, when we're doing this aspect of the table, this is the aspect that I find pupils find more difficult, so that's what I'm going to focus on. If you're systematic and follow what I suggest, you've got more chance of getting this stuff right. So when you're doing this aspect of the table over here, you can ask yourself three questions. You can ask yourself, what accounts change? Which two accounts are going to change? Then you're going to ask yourself, what type of account is each? In other words, is it an asset, expense, liability, income, or capital? And remember, assets and expenses are plus minus, liabilities, income, and capital are minus plus. And then you're going to ask, is each account increasing or decreasing? So let me show you how it works by going through some examples. Okay, the first one says we repaid 5,000 Rand of the loan and interest on loan. Let's start with the loan. Now what I suggest you do on a rough piece of paper is you just draw up rough, what I call T accounts. So the two accounts that are going to change if you pay back a loan, obviously loan will change, and obviously you're spending money, so bank will change. If you pay back a loan, you owe less money. So put a little X on the negative side. And if you spend money, bank is an asset going down, so put an X on the minus side. Then to fill in this table, you look and see which account has the X on the debit side, and it's loan, so over here you write loan. Which account has the X on the credit side? It's bank, so over here you write bank. You then fill in the amounts, and then you ask yourself, loan is a liability going down, so we fill in a minus sign here, and bank is an asset going down, so you fill in a minus sign here, and nothing is happening to owner's equity, so you have to put that zero there. Now you'll notice here that I put a blue line. The reason for me putting a blue line is for me to check after each transaction, because this equation is A must equal O plus L. So I've minus from the left and I've minus from the right. So in other words, that will stay equal. You can't have a minus on the left hand side and a plus on the right hand side. That's like saying minus 3 equals positive 3, which obviously it isn't the case. Okay, and on the same transaction we paid interest on loan. Which accounts change? One must be interest and you're spending money, so the other is bank. Interest on loan is an expense, so it's plus minus. Now you ask yourself, have I spent more or less money on interest? Your answer is more, so put an X on the plus side. And you spent money, so your bank is going to decrease, so put an X on the minus side. Then to fill in the table, which account has the X on the debit side? It is interest on loan. And the X on the credit side is bank. Bank is an asset going down, so you put a minus under A. You've got less money at the bank. Interest on loan is an expense. Any expenses decrease owner's equity. This owner's equity here is the worth of the business. The more your expenses, the lower the worth of the business, and nothing happens to liabilities, and so you put a 0 there. Okay, the next one. The owner increases capital by 50,000. What two accounts change? One must be capital. The business is receiving money, so the other one is bank. I've left some out, I'll come back to it. So bank is increasing now, so you put an X on the debit side. Capital is also increasing, so you put an X on the plus side. Can you see how important it is that you know your plus minus signs here? Otherwise you're going to get the stuff back to front. Right, which account has the X on the debit side? It's bank. And the X on the credit side here is capital. Bank is an asset going up. Capital increases owner's equity. So you put a plus over here under owner's equity and nothing happens to your liabilities. Okay, let's go back to the one I skipped. Sold stock on credit, 2,000 Rand, cost price 800. Now this transaction is a little bit more difficult because 4 accounts are going to change. 2 with the 2,000 and a different 2 accounts with the 800. So let's start with the 2,000, the selling price. Because you're selling on credit, debtors control is going to be affected in sales, and then your cost of sales and trading stock are used for the cost price. If you sell, debtors owe you more money, put an X on the plus side, and you've sold more. Trading stock decreases because stock is going out of the business, and cost of sales increases. In order to earn that sales, you've got a higher cost of sales amount. Please, can I apologize for this croaky voice again? I've done a lot of videos today, and because I've been speaking so much, my voice has gone all croaky. So I apologize for that, and I hope that it's not too distracting for you. Alright, let's go back to this though. Okay, so debtors control has the X on the debit side, so you record under the debit column, and sales has the X on the credit side. Cost of sales has the X on the debit side, so you record it under debit, and trading stock has an X on the credit side, so you record it under the credit column. Alright, now in order to do this, debtors controls an asset going up, so you put a plus under your assets, and owner's equity increases because of that income sales there. Then cost of sales decreases owner's equity because it's an expense, and trading stocks an asset going down. Now, I just want you to have a look at owner's equity here. Can you see we've added 2,000 and we've subtracted 800. So overall we are adding 1,200 Rand here to the worth of the business, and that's the amount of profit that I made. Every time you must also check that the two sides are equal. Remember, you can't have a plus here and a minus on this side. Right, moving on to number 4. The owner used a business EFT for own use. What two accounts change? It's going to be drawings and bank. Drawings is plus minus, bank is also plus minus. Money is coming out of the bank, so you credit it, and its drawings has increased. Which account has the X on the debit side? It's drawings, and the account with the X on the credit side is bank. Bank is an asset which is going down, minus under A, and drawings decreases owner's equity. Now at the bottom here, I've written the word DAS. That's to help you remember, and I suggest you write it down. Owner's equity only ever changes with what I shorten to as DAS, where D is drawings, I is income, C is capital, and E is expenses. So those are the only things that are going to go under your owner's equity. It's a nice way to remember what goes under owner's equity. Right, then we've got cash sales. Once again, we're selling stock, so we need the 4 accounts to be affected. 2 for the selling price, 2 for the cost price. The selling price this time, though, will not be debtors control because it's cash sales, so it will be bank. Bank is increasing, and sales is also increasing. Trading stock is leaving the business, so it's decreasing. Cost of sales is an expense going up. And then you take these and you fill them in. So bank is in the debit column here. Sales is income. Bank is an asset going up. Sales is income going up. And then if you look at your cost of sales, that has the X on the debit side. So you debit cost of sales and you credit trading stock. Trading stock is an asset going down, and cost of sales is an expense which decreases owner's equity. Once again, we've increased owner's equity with the amount of profit that I've made for selling that stock. Okay, the next one, bought stock on credit. If you buy on credit, you're not paying immediately. So therefore your 2 accounts here is going to be trading stock and creditors control. You're buying stock, so it's increasing in the debit, and you owe more money to your creditor, so creditors is increasing. So the X is on the debit side of trading stock. That's an asset going up. Creditors control is a liability, and we owe more money here to the creditor. Nothing happens to owner's equity. Please don't leave the things that don't change as blank. You must fill in the 0 sign. Okay, a debtor repaid his account. It's only at this point that we get money from the debtor. So because we're getting money, the one account here is bank. We're receiving money, so bank increases. The other account is your debtor's control. Someone's paid you back. If they pay you back, they owe you less, so the X will be on the minus side. So bank has X on the debit side, and debtors control has the X on the credit side. Now in this case here, bank is an asset going down, going up. Debtors control is another asset which is going down. So for this case here, we've got plus minus under A, so 2 things are not affected here. We had one asset going up, the other asset going down. Okay, then received rent. What 2 accounts change? Obviously bank and rent. Bank is an asset and it's increasing because you're receiving money. Rent income is an income minus plus, and you've received more rent. So the X is on the debit side of bank. So you debit bank, a plus under asset. You credit rent income. That's income which increases owner's equity. And nothing happens to liabilities. And then the last one, repaid a creditor, 14,000 Rand. The 2 accounts are affected here will be bank because you're paying money, so bank goes down. You've paid back part of your liability. That means you owe less money, so creditors will get debited. So the X is on the debit side of creditors and credit side of bank. We debit creditors control, liability decreasing. We credit bank because that's an asset going down and nothing happens to owner's equity. Okay, so if you get asked this, please try and be systematic. Remember the questions you ask yourself: what accounts change, what type of accounts is each, and whether the accounts go up or down. Then you use your little T accounts as workings, and then just decide where you need to put the X's, and wherever you put the X's in the account, put that account in the same place. So X was debited in loan, so loan is debited. X was credited in bank, so bank is credited. It actually works well if you use these little ledger accounts to help you. Otherwise you're going to start mixing things up. Obviously though, gentlemen or ladies, if I'm speaking to ladies, you cannot do this work if you don't know this, which is your types of accounts. If you don't know what type of account something is, you're not going to know if it's plus minus or minus plus. So the types of accounts are very important, and that's something that you need to learn. Okay, that was quite a long video. Hopefully it will help you with any tests or questions that you get on this work. Thank you.